The stock market can be a very scary place. Today I'm going to show you how to make the stock market a less scary place by investing in bonds. At the end of today's video, I have an added bonus for you. I will tell you exactly how much bonds I have in my investment portfolio, how much bonds my wife has in her portfolio, and how much bonds my mom has in her portfolio. We're going to start with a little bit of a flashback. Back in 2002, I graduated from college and I got this job at the investment firm Morgan Stanley. I was actually living at home and saving a ton of money during that time. Even though I didn't get paid that much, I was able to save up about $20,000 in a period of 2 years. So in 2004, I put in my life savings at that time, $20,000, into the stock market. By the time it was 2007, my money had grown to $30,000. That was a 50% gain, and I was super excited. I thought that nothing can ever go wrong. At that point, just as you would expect, my money started going down. The stock market was tanking, and the $30,000 that I had now dropped down to about $18,000 within a period of a few months. I was so scared, I just sold everything. And when the stock market kept going lower and lower, I thought to myself, I made the right decision. In fact, if I hadn't sold everything, at the bottom of the market, my money would have been only $15,000. In hindsight, I thought, at least I didn't get all the way down to $15,000. I sold when I at least had $18,000. And I was pretty happy. But the real story is what happened in the long term. If I would have only held on to that money that was invested in the stock market and left it alone, I would have made close to $120,000. I wish I had known about bonds, because if I had bonds in my investment portfolio, I would have actually stuck it out. Before we get into that, let's first discuss what is a bond and how is a bond different from stock. A stock is an investment mechanism where you get to be a part owner of a publicly traded company, like for example, Microsoft or Apple. When you pay some money to buy shares of a company like Apple, you get a piece of Apple that you hold on to. If Apple does well, your portfolio value goes up. And if Apple does poorly, your portfolio value goes down. A bond, on the other hand, is a type of investment that's issued by a company or a government entity. And when you buy a bond for, let's say, the US government, what'll happen is you are essentially loaning that money out to the government. And in return, the government will pay you for a fixed period of time regular interest payments, which are usually issued every 6 months. And you keep collecting these interest payments until the bond matures. At that time, the government will return back the initial amount of money that you bought the bond with. In the short term, stocks are much more volatile than bonds. What I mean by that is stocks fluctuate up and down to extremes, but bonds, on the other hand, have much more stable prices. However, the flip side of this is stocks can give you much higher long-term returns compared to bonds. With all of that in mind, let's go back to my situation again. Instead of investing my entire $20,000 into stocks, what if I had put $10,000 into bonds and $10,000 into stocks? The blue line in this graph is 100% stocks, and the orange line in this graph is a 50-50 portfolio, meaning it's 50% bonds and 50% stock. We already know what would have happened if I would have invested all my money in stocks. My initial $20,000 would have dropped all the way down to $15,000 at the bottom of the market. However, if I would have invested in a 50-50 portfolio, that's 50% stock and 50% bonds, even at the bottom of the market, my initial investment of $20,000 would have remained the same. So I wouldn't have freaked out and pulled all my money out of the stock market. I would have stayed in the market and would have been invested for the long term, and my money would have grown much more. Now let's take a look at the difference in these two portfolios in the long term. In the long term, you'll notice there is a lot less volatility in the 50-50 portfolio. If you look at the points in which the market dropped, the drop is not as drastic with the 50-50 portfolio when compared to the 100% stock portfolio. However, this lower volatility is a double-edged sword. Just like the 50-50 portfolio doesn't drop as much during market downturns, the 50-50 portfolio doesn't also go up as much as the 100% stock portfolio in market upturns. So if you were to remain invested in a 50-50 stock portfolio over the last around 20 years, that $20,000 initial investment would have only increased to about $70,000 with a 50-50 portfolio. But that same $20,000 investment would have grown to $120,000 with a 100% stock portfolio. So your goal is to find the right mix between stocks and bonds, which will enable you to not get too scared of the stock market where you pull out your money, but at the same time, you want to have as much stocks in there so that you can maximize your return in the long term. How do you actually find that perfect mix of stocks and bonds ratio that's right for you? In order to figure this out, a good starting point is something called the 120 rule. The 120 rule is where you subtract your age from 120, and that gives you the percentage of stocks that you should own in your investment portfolio. And the rest of the money will be invested in bonds. So for example, for a 30-year-old person, the portfolio mix will be 90% stocks and 10% bonds. That's because when you subtract 30, which is the age, from 120, that gives you 90, which is the percentage of stocks. And then the rest, the 10%, is invested in bonds. Similarly, for a 50-year-old, the portfolio mix will be 70% stock and 30% bonds. And for a 70-year-old, it'll be a 50-50 portfolio of 50% stocks and 50% bonds, and so on. This is only a starting point because let's be serious. Not every 30-year-old that you know is the same kind of person, and not every 50-year-old that you know is the same kind of person. So once you have the starting point, you can tailor it depending on the person that you are. Are you the kind of person who will freak out when the stock market drops? Or are you the kind of person who can sleep through the night when the stock market drops? So let's look at a few other factors that should affect your decision. The first factor is your age, and that's captured by the 120 rule. The next factor is the time horizon for the money that you have invested. Although that sounds like it should be tied to age, that's not always the case. So for example, if you're a 30-year-old that wants to buy a house within the next 5 years, you should be invested more in bonds rather than stock. That's because you need the money very soon. But if you are a 30-year-old who is never planning on buying a house, and you don't need a big chunk of money at your disposal, then you can be invested for the long term. If you're the kind of person who has nerves of steel and you can sleep through the night when the market drops, then you should be invested much more in stocks than bonds. And the final factor to consider is the amount of returns you want from your investment. As we saw from the previous graph, if you're invested in stocks more than bonds, you will get a higher rate of return in the long term. So if you want higher returns, you need to be much more tilted towards the stock side compared to bonds. In order for you to make a more informed decision, Vanguard has a really nice website where it provides you the data associated with these factors. And this is a webpage called Vanguard Portfolio Allocation Models. I've linked this website in the description notes, so you can go and take a look at it whenever you have a chance. Here's an example of how you would use the information on Vanguard's website. Vanguard has collected data from about 100 years, specifically from 1926 to 2021, to see how different portfolio allocations perform. On the left-hand side, we have a portfolio allocation that is heavily invested in stocks compared to bonds. Specifically, this portfolio has 80% stocks and 20% bonds. On the right-hand side, we have a portfolio allocation that is heavily tilted towards bonds. It is the exact opposite mirror image. Here, the portfolio is allocated 20% to stocks, but 80% to bonds. The key piece of information you should look at here is the worst year and look at how badly that particular portfolio performed in its very worst year. For the stock-heavy portfolio allocation, in the very worst year, the portfolio dropped about 34.9%. That is a huge drop. Now you should be thinking, if that were to happen to my portfolio, can I sleep through the night with that heavy of a loss? On the other hand, if you look at the bond-heavy portfolio, the worst year, which was in 1931, was only about 10%. And if you think about it, if that's the worst possible scenario that's happened in the last 100 years, how bad can it be if you're in a bond-heavy portfolio allocation? That's only part of the picture though. You looked at how risky a particular portfolio allocation is. Now you need to look at what are the rewards that you can get by picking a particular portfolio allocation. For the stock-heavy portfolio, the average annual return over the last 100 years was around 11%. That is an extremely high average annual return. Now contrast that with a bond-heavy portfolio. The bond-heavy portfolio only returns about 7.5% on average per year. Although the bond-heavy portfolio is less volatile than the stock-heavy portfolio, the trade-off here is that the bond-heavy portfolio has a lower average annual return. Let's go ahead and put this all together. Here is how you're going to find out your perfect stock to bond ratio. First, you'll start with your 120 rule. And if you remember, this is the rule where you take the number 120 and then subtract your age to get the percentage of stocks in your portfolio. The rest will go in bonds. Once you have that initial number from the 120 rule, you'll then adjust it based on your own personal preference. You'll use factors such as the time horizon when you'll need that money, your risk appetite, and what kind of returns you're looking to get. And in order to get this data, you'll go to the Vanguard website, which I've linked in the description box below. Great. Now you know how much bonds you need in your portfolio. The next step is, how do you actually buy these bonds? If you've seen any of my previous videos, you already know that I'm a huge fan of diversifying your portfolio. And that's the same when it comes to buying bonds. I like to buy various types of government bonds and various types of corporate bonds all in one shot. The perfect way to buy this basket of diversified bonds is through a total US bond index fund or a total US bond exchange traded fund, also known as an ETF. To buy the index fund or ETF, you need a brokerage account. For example, a brokerage account at Vanguard, Charles Schwab, or Fidelity. If you don't already have a brokerage account, I have a video about how to open a Vanguard brokerage account, and it's outlined step by step. I'll link that to the description. You can go ahead and take a look there. Now, depending on the brokerage account that you have, my preference is to invest in index funds over an exchange traded fund because index funds allow automatic investing. That way I can set up a certain amount of money with which I want to buy bonds month after month. However, if you buy ETFs, there is no automatic investing option and you'll have to do that manually. In order to purchase an index fund, you'll have to buy a particular version that's offered by your brokerage account. So Vanguard has its own version of a bond index fund called VBTLX. And then Schwab has their own version of that index fund called SWAGX. And similarly, Fidelity has its own version called FXNAX. The reason you want to pick your brokerage's particular version of the index fund offered is because with their own version, they don't charge any transaction fees. If you want to invest in bonds through an ETF, my top pick is BND. BND has the highest number of bond holdings compared to any other ETF. BND has 18,000 bond holdings within that ETF, and when you buy a share of BND, you'll get access to all of these 18,000 bonds. And you can buy BND through any brokerage account and they don't charge any transaction fees. One thing to note in this slide is that out of all of these different options, Vanguard's index fund has a $3,000 first initial purchase minimum. None of the other options have this minimum. We are almost at the bonus portion of that video that I promised you. But before we get to that, if you found this video helpful, it would be great if you can hit the like button so that other folks who are also interested in personal finance can find this video. Without further ado, let's talk about how much bonds I have in my portfolio, how much bonds my wife has in her portfolio, and how much bonds my mom has in her portfolio. Let's talk about my portfolio and my wife's portfolio first. We are actually invested in 0% bonds. Our entire investment portfolio is in stocks. My wife is in her late 30s and I'm in my early 40s. Now you might think that's pretty aggressive given our age, because if you calculate out the 120 rule, we should be invested somewhere in the 80% stock range and 20% bond range. But there are other factors that bring us to this 100% stocks allocation. First and foremost, we have a cash emergency fund that'll cover 6 months of our expenses, and that emergency fund gives us a lot of peace of mind in case the stock market drops. We know that we're at least covered for the next 6 months, even if we lose our jobs at the same time. Next, we keep our monthly expenses quite low compared to our income. Again, that gives us peace of mind because we know that even if we were to lose our jobs and our emergency fund were to run out, we won't need a big cash outlay every month after month. Next, we have both lived through market drops, so we know that in the long term, even if the market drops, it'll recover and go even higher. And finally, this is a superpower that my wife has. She actually doesn't care what happens in the stock market. She doesn't listen to the news about the stock market every day. She just puts her money in there and just forgets about it. That helps her stay in it for the long term. Now let's take a look at my mom's bond allocation in her portfolio. My mom holds 30% bonds and 70% stocks. My mom is now in her 60s. You'll notice that this is a pretty stock-heavy portfolio for someone in their 60s based on the 120 rule. My mom's reason for this particular allocation is she also has a cash emergency fund that covers 6 months of her expenses, and her monthly expenses are extremely low. And finally, just like my wife, she has the superpower of not caring about what's happening in the market day to day. So she doesn't worry about whether the stocks are up, stocks are down. She just invests for the long term. If you found this video helpful, hit that subscribe button so that you know when future videos come out. And I'll see you soon.